Thanks, everybody. We're going to do a little bit of a lesson today. And sometimes we'll talk about something very stock related, but something happened. And if you were paying attention to the nonsense that was the SEC Twitter account and dropping this Bitcoin ETF false tweet, it immediately made me think of something that is useful to every single trader, just useful in life in general, when it comes to risk management. So the long story short, there was an erroneous tweet sent out by the SEC when everybody's already expecting the approval to come today. This tweet was yesterday. Everyone's on guard for it, saying that Bitcoin ETF approval were through and made. There was a crazy price action. Coinbase in the aftermarket went up $4 and then down $8 when they realized it wasn't true. It turns out that there is the possibility that the SEC did not have two-factor authentication on their Twitter account. And that is absolutely a fail, if it's true. But it made me immediately think of something. And that is, if you are the SEC and there's that big of a deal, if you send things out, they can move the market and real money can be made or lost by people, why would you not take such a very simplistic step? Whether or not this is the problem, why wouldn't you take a simplistic step to mitigate that risk? And it's something that actually plagues traders, I believe, all of the time. Because when you have a large downside risk, but it's a very slim chance of happening, we tend to ignore it. If you've never read Nassim Taleb and you've never heard of what a black swan is, then you should go ahead and read everything the man's ever written. This is similar to that. It's not exactly what he's talking about, but it is very similar to that notion. And we, as people, human beings, have a problem with this. I'll give you an example. I take the subway, I take trains all the time. How often do you see somebody standing on the edge of a platform past the old yellow line just because they're so casual, I'm not going to fall in? What do they have to gain from that action? Zero. What do they have to lose from that action? Well, they could slip, a gust of wind, someone could bump into them, they could lose their life. That's a 1 in a billion chance. But taking 2 steps back costs them literally nothing and is a 1 in a billion chance of saving their life. I use this example for a reason, because most people are going to listen to that and say, I'm still not taking a step back. But if I flip it around the other way and say to you, well, you have a 1 in a billion chance of winning Powerball, would you buy a Powerball ticket and before checking the number, tear it up and throw it out? Nobody would ever do that. There is no chance you would have a lottery ticket that's a slim chance of hitting, buy that ticket, and then rip it up without checking it. You're going to check it on the off chance that you won. So why is it that when there is a big upside that we can see, and it's a small cost, we're going to take that action 100 times out of 100? But if it's a gigantic downside, which a really, really small chance of happening, we won't take easy steps to mitigate that risk. It's like putting on a seatbelt. Two-factor authentication in that particular case. Taking a step back on the subway. Looking both ways before you cross the road. It is mind-boggling that we have these issues as human beings, and acknowledging them is one of the first steps. Now, the reason why this matters in trading is I have seen a few times traders blow up accounts because they did not consider low probability downside, massive downside risk. Where they're taking a trade and their risk isn't that they're wrong in the trade, their risk is I get caught in the aftermarket and there's no liquidity. I execute the trade before the oil number is out and I'm executing into a vacuum and there is no liquidity and I get stopped out for a huge move. I make a trade during an earnings call and my stop runs and there's no liquidity because the price thins out. Not that their technical ins and outs aren't good, but then when something parabolic happens, even if it's a low probability event, they find themselves caught up in it. You should always consider the massive downside risk and what you can do to protect yourself against it. I think it's crucially important because we as human beings, we think we're human beings, there's a few robots probably out there somewhere, Mark, but we as human beings are very susceptible to this issue. I'm giving you everyday examples of it. The SEC, they're the SEC. How could they not have had two-factor authentication on there? It seems so simplistic. But these simplistic steps that you can take every single day as a trader can sometimes save you a bundle. If the trading platform you're on comes up with a new gateway or there's a new way to execute, how much time does it take you to test it out, go over it, read the notes that they put out? Probably not much. Does it matter most of the time? It might not. But if it does matter and it becomes a big deal, you want to know. And I've seen that happen before. There was one time there were traders trading, and I'm not going to name any names, and I'll leave you with this. There were traders trading in the aftermarket and making good money trading on earnings plays. And there's a rule on specific gateways about how aggressive your orders can be that you throw to the market outside of the market. So if you're using limit orders instead of market orders, you could only throw an order so far out. And I'm going to go to my chart here for a second to show you an example of why this would burn you. So here is Coinbase. Come to my chart here. Here is Coinbase aftermarket. The example I will give you is, imagine someone was going long in the aftermarket expecting an explosive move, and they don't want to use a market order. So they go long here and they think, oh, if it starts breaking down, I'm just going to cross with an order $10 down, and then I'll get liquidity back through 55. So 56 long. When 55 breaks, I'm just going to cross down like $10 or $20. Doesn't matter. I'll get the best fill, whatever it happens to be. There was actual rule on the gateway they were using that limited how far they can cross. So what happened when 55 triggered? Instead of getting filled here, their order rejected. Rejected order, and it filled down there. That was a rule on that gateway. All you had to do is know that rule, change your order, and save yourself a 3, 4, 5% move. That is the kind of thing I'm talking about. The SEC taught us all a lesson yesterday about taking simple steps to avoid massive downside risk. And if you're a trader, you should be concerned with that every single day. In life, you should be concerned with that every single day. So that's my lesson. That's my rant. Watch out for that big downside risk and take all the simple steps that you can to avoid it. Save yourself a bundle of money and maybe save your life. Who knows?